What's a good discussion, in my opinion, is at what price of the dollar would I buy 10-year treasuries? So look, gold at $15,000, $20,000 an ounce, I will happily buy 10-year treasury yields at 3%. I'll sell gold and buy 10-year because the dollars that I will be receiving in interest and holding in that bond will be properly valued relative to the amount of debt and what have you out there.
Huge, absolutely huge amounts of gold and silver are being sucked out of Western capital markets and going into Asia. I mean, demand from India for silver is enormous, absolutely enormous. And you've got this clash, if you like, because industrial demand for silver on its own has led to a supply deficit for the last 5-6 years. And of course, the silver goes up as gold goes up. Every Asian with any wealth to protect.
Gold and silver have stopped behaving as ordinary commodities. They now signal confidence, debt stress, and the falling value of paper currencies. The key message: government support for bond markets may weaken currencies and push gold prices higher. Luke Gromen and Alasdair Macleod explain that gold could eventually reach levels like $15,000 to $20,000 an ounce before bonds become attractive again. In that kind of world, gold is not just rising because investors are bullish. It is rising because the dollar, the euro, and other fiat currencies are losing purchasing power relative to real money. At the same time, massive amounts of gold and silver are moving out of Western markets and into Asia. China, India, and other buyers are treating precious metals as a form of financial protection, not speculation. And if this trend continues, the pressure on gold and silver could intensify. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Yeah, I think we're into a stage where when we just take a step back from, hey, are they going to save the currency or the bond? Like, we know what they're going to save, right? They're going to save the bond market and throw the currency under the bus. So to me, the only way out of this is severe financial repression, much higher gold price. And I think ultimately we're in one of these cycles that we've seen several of. We saw it in the 30s, we saw it in the 70s, we saw it in the 2000s a little bit, less than in the 70s, but where you get 10, 12 years where gold just really outperforms. And I think ultimately gold probably on the S&P, I think it's what, it's 0.6 now, something like that. I think it goes, in generational lows, gold to S&P has gone, or S&P to gold, has gone to 0.1, 0.2, so to me, I think at S&P to gold at 0.2, gold to S&P at 0.2, I guess is the right one. Yes. No. S&P to gold at 0.2. Yeah. I think that's kind of, I think that's where it's going to go. And the reason I think that is ultimately, not only do we need to devalue the debt, but when we look at what the Trump administration is doing, Defense Production Act for petroleum and infrastructure, you're basically printing money to reshore. That is a fundamental change of flows of the global trading system. That means you cannot use U.S. Treasury bonds as your primary reserve asset going forward. You have to use something else. And the only other thing that is big enough to run the deficits is gold. So people always ask, well, what's going to run the deficits if America's not running the deficits? And I point them to, it's not even speculative, it's a fact. Gold's going to run the deficits. Gold is running the deficits. We can see this. Gold's share of global FX reserve is now bigger than U.S. Treasury bonds. And these, critics will say, oh, it's all just gold price. I say, exactly. That's the point. The same person that says, well, it's just gold's price. It's not gold tons. It's like, do these people count their 401k in number of shares they hold? No, of course they don't. They count it in what the money they put in and what's the S&P done. That's how they count it. But for some reason, some people go, oh, well, it's just all because of gold's price. No, exactly right. Gold's price is going to go up, run the deficits basically, basically become big enough to be the reserve asset as the U.S. reshores. That's a really good outcome for America. It's a really good outcome for the world. Let's see if we can continue on the path. Maybe this whole Iran thing is just political cover for it. I don't know. I tend to not give them that much credit in terms of trying to plan the unplannable. But I would be trading it before that. I would, it'd probably be scaling. Gold's an overweight for me, and has been for a long, long time, a significant overweight. And so, yeah, I would be scaling some in at probably 0.3, probably at, a lot at 0.2, just because I'd be surprised if it actually got to 0.1. But I would never sell all my gold, just because what did Ray Dalio say? If you don't own gold, you know neither money nor history, or you don't understand economics or history. And I think that's right. Is ultimately, for me, it's all about what's the price of things, in gold. And to a certain extent in Bitcoin, if it ever, as volatility in Bitcoin comes down over time, you can have that same discussion about Bitcoin. People have asked me the same about treasury bonds. What price, what yield would you buy 10-year treasury bonds? For me, it has nothing to do with the yield. The U.S. government can't afford over 4.8%. So it's like how many whatever can you stand on? How many camels can you stand on the eye of a eye or on the head of a pin or whatever? Right? How many angels on the head of a pin? Who cares? It doesn't matter. It's a silly discussion. Now, what's a good discussion, in my opinion, is at what price of the dollar would I buy 10-year treasuries? So look, gold at $15,000, $20,000 an ounce, I will happily buy 10-year treasury yields at 3%. I'll sell gold and buy 10-year because the dollars that I will be receiving in interest and holding in that bond will be properly valued relative to the amount of debt and what have you out there. That's how I think about that. And from the S&P standpoint, given that everything's kind of a derivative of treasury markets, and same kind of dynamic. I will happily sell gold by S&P when S&P is more appropriately valuing the dollar relative to gold, given the fiscal situation of the U.S. and the West more broadly.
They own dollars. Do they want to own dollars? No, they want to sell dollars. What do they sell dollars for? They sell it for euros? Yen? No. They want to get out of fiat currencies because they see the danger. The reason that they have accumulated gold, the reason that they've now opened vaults outside China where trade partners can buy and sell gold for Chinese yuan, is quite simply that they have planned to divorce themselves from what they see as the inevitable collapse of the Western fiat currency system. And that's why you've got this dichotomy. I mean, in the West, fund managers think that safety is to get into dollars cash if you're running your portfolio in dollars, or euros if you're running it in euros. Whereas the Chinese see safety as getting out of the fiat currencies. And that explains why gold and silver are basically being sucked out of the West. I mean, it's just amazing. There's a chart that you can get on the St. Louis Fred system showing the value of gold being exported by America. I mean, it's off the charts. Something like, 32 billion a quarter or something. I mean, huge, absolutely huge amounts of gold and silver are being sucked out of Western capital markets and going into Asia. I mean, demand from India for silver is enormous, absolutely enormous. And you've got this clash, if you like, because industrial demand for silver on its own has led to a supply deficit for the last 5-6 years, which has only really been made up in the past by China trying to suppress the price. And it was when they stopped suppressing the price, in late September last year, that silver really took off. Those days are gone. And of course, as silver goes up, as gold goes up, every Asian with any wealth to protect thinks, this is the new game. I mean, let me put it this way. If you look at household savings in China, they amount to around about $5 trillion equivalent accumulating every year. $5 trillion equivalent. That, it's about 30 to 35% GDP, of China's GDP. Now, where are they going to put it? Do they put it in property? Yesterday's story. Do they put it in the stock market? Well, yeah, some of that, if you can understand what you're doing. Where does it go? It goes on bank deposits. And what do the banks do? The banks offer, alongside your deposit, a gold accumulation account. And what you can do for 500 yuan, which is the equivalent of about $75 or something, you can open a gold accumulation account, and you can arrange for monthly payments to go from your deposit account into your gold accumulation account. So, we're looking at the thick end of $5 trillion overhanging the domestic gold market from within the banking system. We're not even talking about delivery of small bars and coins and stuff, as a result of withdrawals from the Shanghai Gold Exchange. So you can see that this is something which is just mega. And as gold gets driven up by this demand, then what happens to silver? Well, that's the cheap man's way in. And as far as Asians are concerned, their experience of silver as money is at least as recent as ours. In fact, more so, I would suggest. So that's what's happening. And meanwhile, our fund managers are driven, if you like, by their own regulators. And, the regulators who say gold is not a regulated investment. Thou shalt not buy it. In accounting terms, obviously, if you're running a portfolio and see risk everywhere, you just get out of assets and you get into cash. And you say to your client, I've been very clever. I have protected you from all this terrible stuff that's going on, which completely ignores the collapsing purchasing power of the cash that you've actually moved into. That's where we are.
Silver could be the most dynamic part of the story. Industrial demand has created a supply deficit for years, and investment demand is rising too. Sectors like solar, EVs, weapons, and infrastructure all require silver, yet supply remains tight. The key point is that silver is not easy to increase quickly. Much of it comes as a byproduct of copper and other mining operations, so even if the price rises, new supply may not respond fast enough. That creates a dangerous setup in which demand keeps growing while available metal remains limited. The outlook from this discussion, silver could climb much higher over the next few years, possibly beyond most mainstream expectations. Though short-term swings may be volatile, long-term math still indicates a tighter market ahead. Let's get back to the interview.
It is, I had a friend of mine sent me a fascinating write-up. This was probably in December, maybe, from a retired long-time, I think he was a CME guy. But at any rate, it was one of the more fascinating emails I've ever read, because it just went chapter and verse on the supply deficit that you discussed, right? Like, here's where the U.S. Geological Survey is saying supplies are, here's where they're saying what recycling is, and here's the balance they're getting to. But their numbers are highly suspect, because if you, the solar panel industry puts out very detailed, here's how many installs you have in the U.S., around the world. We know with pretty high degree of certainty how much silver is in each solar panel. And when you do that math and then you throw that in there, and then you throw in some EVs and you know those numbers roughly, and then you throw in some cell phones and some of these other things that silver are used in, and you come up with this demand number that is like, I mean, the number that the Geological Survey was coming to, you almost can't get to their number. In other words, demand was just so much higher than supplies, and has been for years, and you've got this ramping in EV, et cetera, and then you layer a war on top of it where silver is in some measure used in a lot of these weapons that we've been using, and that just adds to the issue. And this was right around the time silver went from whatever 70 or 80 up to 125 pretty quickly, and came back down. So I've not spent a lot of time on silver since. I didn't, I have always had a small position. I didn't sell any up there. It's physical. I just sit tight basically with it until I really feel like it's more fully priced, I suppose. But I go back to that write-up, And I kind of go, okay, well, what's changed? Well, if anything, everything that has happened in the Straits, we're seeing worldwide stories of EV adoption rising rapidly. Okay, well, that's a greater call on supplies, or on supplies. Solar, you're seeing more installs there. Okay, weapons, everything that was sort of contributing to this strong demand picture is increased in the last 4 months, and so. To me, what is silver going to do in the next couple of months? I don't know. What do I think it's going to do in the next couple of years? I think it's probably going to go higher and quite possibly quite a bit higher. Because I just look at this and go, I don't see, the math ain't mathin', as they say. So that's how I think about silver. And then, to your point, the sulfuric acid. You're talking about the demand side has risen, but now you're talking about quite possibly the supplies, right? It's a byproduct. Silver is a byproduct of some of these other processes, which are being flow restricted by the lack of sulfuric acid. Copper mining, for example. You start restricting copper mining around the world, you're going to start restricting silver output into a demand situation that's accelerating into a supply-demand balance that was already skewed in favor of demand 4 months ago when this all started. So to me, I think silver probably is a lot higher in a couple of years. In the short run, it's also a critical mineral. It was designated as such by the U.S. government whenever October of last year, I think, maybe in November. And we're in the fog of war, and prices convey information. And I have seen things that I have thought have been the management of price information during wartime in the last several months. I know of several instances where that is absolutely happening, and that's just the nature of the game, and that is what it is. That's fine. That's, I think, just needs to inform investors of, hey, I'm not saying the price is completely disconnected at all times. I'm saying you should, as an investor, expect the disconnection of price and value to occur at times, and to adjust how you buy, sell, etc. accordingly.
That is going to happen at some stage. Of that I have absolutely no doubt, simply because China will secure the value of its yuan by making it convertible into gold. I mean, probably only for international trade settlements, rather like a sort of Bretton Woods Mark II, but based on the yuan. In order to do that, she will have to make that statement. Now, the moment she makes that statement, all the other fiat currencies are doomed. I mean, it's quite simple, doomed. That's why she's actually very reluctant to make the statement. She doesn't want to put the yuan onto a gold standard and be accused of destroying the entire Western financial system. So she's got to play this very, very carefully. It's got to be absolutely obvious that we're destroying the financial system, not China, and that China's response is to protect her own interests. I think this emphasis is absolutely crucial, and I'm sure that the Chinese leadership, are thinking this way. They must be. I mean, their whole approach to this is: look, don't put your head above the parapet. Don't appear to be disrupting things internationally. Just be honest with trade and all that sort of stuff. Don't interfere with other people's politics, with their agendas, whatever it might be. We just look after ourselves and we just don't interfere. And that's basically what they've been doing, really, ever since since Deng became premier. So this is. And I mean, it's completely in accordance with Confucian principles. I mean, China takes the view we've been around for 5 millennia. We're not going to suddenly behave as if we haven't been around for 5 millennia. So I think that's, it says it all. When that happens, gold measured in dollars, in sterling, in euros is going to be infinite. Because this is the key. Kai. It's not gold going up. It's our fiat currencies going down. And as a result of the Iran conflict, the speed at which our currencies are going to go down has been accelerated very, very significantly. That, I think, is the key point to understand.
The deeper warning is that this is not only about price targets. It is about a possible reset in how the world values money. If China eventually links international trade settlement to the convertibility of gold-backed yuan, it could create a major break from the Western fiat system. That would not simply make gold look stronger. It would expose how weak paper currencies have become. Alasdair Macleod's point is especially important. Gold is not really going up in the old sense. Fiat currencies are going down. And when investors finally understand that difference, gold and silver may be repriced in a much more dramatic way. Luke Gromen adds that gold at $15,000 to $20,000 could be the level at which the dollar is finally valued correctly relative to debt, deficits, and the bond market. This is why tracking physical metal flows is critical. As gold and silver exit Western markets and move into Asia's stronger hands, the available supply for paper-driven markets becomes more fragile. If confidence breaks, repricing might occur far more quickly than most people anticipate. Share your thoughts on their analysis in the comments section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.